So Tesla's now gone from the 400s per share to the 600s in as little as 30 days. Option traders have seen call options jump nearly 10 times in value during the same time. But now that Tesla is going to be included in the S&P 500, is this a sell the news event, or does Tesla go higher? I'm going to show you what I'm doing with Tesla, regardless of where it ends up going. All that and more coming up right now. Hey everyone, Tom Gentile. Welcome to Tom's Trading Room. You know what we do here. We look to spot opportunity and create alternative strategies other than simply buying and holding. Do me a favor right now. Don't hold any longer. Hit that like button. It helps support the channel. And if you subscribe, that's the button on the other side, then you'll get these videos as soon as they're uploaded. You want to know what I'm doing with Tesla? Well, let's go to the screen and find out. Okay, so to fully understand what I'm doing, let's first look at the past. So between the end of summer and about the middle of November, what did Tesla do? Well, it started making what we call lower highs and higher lows at the same time, creating a bit of a triangle pattern. Well, after the 16th of November, we broke out of that triangle pattern, and you can see over the next 30 days, we went from around the $430 mark all the way up to $650. A better than 200-point run in less than 1 month. You know, with Tesla moving around quite a bit, it's caused emotions for a lot of traders, and that's what we're seeing a lot of this big push happen. Technically, from here, we've kind of ran into a stopping point. So it's hard to figure out, and you know, fundamentally too, especially since the news of the S&P 500 should have pushed this above 650, nearing 700. The chart that I'm most interested in, however, is we know what the chart did between November 16th and mid-December, but look what the implied volatility did as well. Obviously, the time to be a call buyer was down here and in the November 16th time slot, because now that Tesla's gone higher, is it time to potentially sell these options? Well, let's look back on November 16th. At November 16th, at the money calls, all right, or slightly out of the money calls, let's call it that, we're trading for around $22. As you can see, these were the December 18th 420 calls, 1 month calls, trading for a little over 22 bucks. And so to purchase one of those calls meant it was going to cost you about $2,228 for one call option. All right. From there, we can see that we have upside, all kinds of upside profit potential, but we have limited downside risk. And anyone who bought calls back in mid-November and hung on to them, well, you got to be patting yourself on the back with that one, because 30 days later, those call options in Tesla, all right, those $20 call options, as Tesla traded above $600 a share, the call options were trading for over $200 a share. And in fact, they were well over $200 a share, making these options jump up by a factor of 10. That was a 1,000% gain from mid-November to mid-December. Okay, so what's the big takeaway? Well, the big takeaway was that in November, Tesla's options were actually experiencing what we call low implied volatility. Now, the options were expensive, but they were on the low side of expensive. So as the stock moved higher, the calls moved higher, the implied volatility moved higher too, and that actually helped the call buyer make a little more money than they expected. So moving forward, what's the best strategy for trading Tesla today? All right, so I believe the best strategy is on the sell side. So when implied volatility is low, it's great to be a call buyer if you're bullish. It's great to be a put buyer if you're bearish. But when option implied volatility gets high, it makes calls and puts more expensive. And therefore, A, you don't make as much if you're right. B, you could even lose money and still be right. So when volatility is high, I like to be a seller. And that means if I'm bullish, then I would look at selling at the money puts. Now, I've done videos on how to sell at the money puts in the past that are right here on this channel, so go check them out. But if you're bearish, you could, if you have the money and the stamina, sell out of the money call options, because selling out of the money call options is a bearish strategy. All right, now the net result of either one of these is a credit to your account. So they have limited reward, they have substantial risk. They do come with substantial risk. Now I'm looking at Tesla, and I'm seeing a couple things happen. First of all, the implied volatility is actually quite high. All right, so when you look at, for instance, this chart right here, and we see this volatility that's extremely high right now, where it was down here near 50, and all of a sudden, less than 30 days later, we're trading up near 120. That's more than the double in the options premium. So that tells me that I want to be on the sell side. And if I want to sell, why not by looking at the chart? If the chart is really looking like it's starting to fizzle out over here, couldn't we sell both? Couldn't we sell out of the money puts and out of the money calls? Absolutely. That's called a strangle. And a strangle is when you take an out of the money call and an out of the money put using the same expiration date. And by selling strangles, we would sell those options to open a position in our account. Now, the cost and the risk on this is high because if this thing gets outside of the strikes, if it goes down, I'm obligated to buy the stock. But if it goes up, I'm obligated to sell the stock, and I might not even have the stock to sell. So if I'm obligating myself for an uncovered call position, there's some risk to it. The reward is that you get that credit you've received and up to and only up to that credit. So why in the world would anybody do this? Because of one word, probability. Now, I want to show you what I looked at today, Monday. I'm actually going back and I'm looking at Friday's closing prices on Tesla. So with Tesla trading and closing on Friday at $610 a share, that was on December 11th, 2020. Look at what I found, the 800 calls, all right? Highs that have never been seen in Tesla. And this is options that expire this Friday. The 800 calls were trading at $3.28. This was on the close of Friday, all right? On the close of Friday also, the 500 puts were trading at a level of just below $5. Again, this was with the stock trading at $610 a share. Now, I want you to look at something real quick. The 800 calls, right, were farther away. They were 190 points away from the stock price. That's why they had a lower target or lower premium on them than the 500s, which were only $110 away. They were trading for roughly $4.95. So a strangle trader would take the cost or the premium of the call and the put, add those together, and that is your maximum reward potential. In this case, you're looking at somewhere around $823 when you add up the mid price of the call and the mid price of the put. Add those together because you're selling each. You're bringing a premium in that you are hoping to keep. Now, this is a 1 week trade. This is a short-term trade. So where this hurts us is if Tesla gets above 800, that's where the risk is, or if it goes below 500 in the next 5 trading days, right? Now, I actually saw these trading, both of these together on Friday in the middle of the day. They were trading for over $10. So you could actually bring in $1,000, even a little bit more for this position. And it actually started dropping Friday afternoon. But on Friday's close, if you to put this trade on, you're talking about $823 of credit for one contract, one call option, one 800 call, and selling also one 500 put. $823 into your account. Now, the goal is that Tesla stays in between this wide range here, between now and Friday's expiration. And on Friday's expiration, if we're trading between these two, we could possibly keep the entire amount by just letting both sides expire worthless, and that's the plan that I do when I look at strangles. Placing an order like this, let's say we wanted to take 10 points in, then I could place a strangle order, and it would look something like this. Tesla strangle, and I would sell to open the December 18th 800 calls and the December 18th 500 puts. And I'm looking to do that. And let's say I want to do that for $10 for both together combined. That for every one contract brings in $1,000 in premium. Now, we could let it go, or we could let it go to worthless if we want, if that's our plan. And we never have to buy this back if Tesla remains between $500 and $800 per share over the next 5 trading days. Another way that some people trade options when they sell is to buy back or close the position once you get to the 80% of the credit. So if I look at 10, all right, if I look at $10 and I bring $10 in, if that $10 drops down to $2 and I purchase it back for $2, then I keep 80% of 10 or 8. So you take the total credit received, which is $1,000 on the position or $10 per contract, and you calculate 20% of that number, which is 2, and you set your buy to close at a limit of 2. It would look like this. All right. Again, where we sold to open, we'd simply buy those back to close, and we do that for a limit of $2. It would look just like this. Buy to close the 800, buy to close the 500, all as a strangle. And we would do that for a debit of 2 points. And I put those in as good till cancels if I want to get out of the trade at what I like to call the 80% of the credit rule. So, last piece I want you to consider is this. How much money does it take to put this trade on? Well, that's going to vary between brokers, but it's not going to be cheap because these are both uncovered positions. Number 2, what's the amount that you can make, the possible maximum amount? Well, if you let it go to expiration, the most you can make is what you brought in. And finally, and this is a good question, how can I lower the risk and the cost of this trade? Well, that's something called an Iron Condor, and that will dramatically lower the cost and risk of the trade. And we're going to do that in part 2 of this 2-part video series. In summary, guys, when big volatility creeps into stocks, selling premium is my choice. Now, that comes with higher probabilities, but it also comes with higher risk as the trade-off. And while nothing is a guarantee, I use this strategy a lot when I believe options or option premiums are likely to crash. All right, hey, thanks again for joining me. Have a great rest of your week. Look for part 2. That'll be coming out soon, and we'll talk to you then. Bye now.